Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. market update, sector rotation, MSFT/ORCL deal, SpaceX options, and BOJ policy. This video presents a direct informational narration of the source document. So today's explainer covers a few key areas. We'll look at market breadth and sector rotation, dive into the Microsoft and Oracle cloud deal, check out that massive SpaceX acquisition and options activity, contrast retail versus institutional liquidity, and finally wrap up with BOJ policy and semiconductor technicals. Let's get right into it. Section 1. Market breadth and rotation. We saw a pretty wild split across the four major indices today. It's actually kind of fascinating. The Dow Jones Industrial Average pushed higher, but the NASDAQ went the other way. In fact, this was the third largest daily divergence we've seen between these two indices all year. So what drove that? Well, the technology sector took a 2% hit, and the semiconductor index dropped nearly 6%. That heavy drag really pulled down both the NASDAQ and the broader S&P 500. But here's where it gets interesting. Even with the S&P 500 being dragged down, 9 out of the 11 S&P sectors actually advanced today. The only odd ones out? Technology and energy. We're talking specific weakness across semiconductors, GPUs, CPUs, optical modules, storage, and software. Meanwhile, the cyclical sectors, specifically financials and industrials, really stepped up and recorded the largest gains, essentially balancing out that broader index decline. What we're looking at here is a real rotation of capital, moving out of tech and flowing right into financials and industrials. It definitely suggests market participation is broadening out, which is something we'll be watching really closely as we head into that June 18th triple witching options expiration. All right, moving on to Section 2, the Microsoft and Oracle cloud deal. We've got a massive development impacting the tech sector right now. Microsoft is actually canceling its cloud service cooperation agreement with Oracle. This was a huge deal, originally valued at over $3 billion, with the plan being a migrated chunk of Microsoft's workloads straight over to Oracle's cloud infrastructure. So why the sudden stop? Well, the core issue boils down to Oracle's public cloud lacking a federal authorization management program. Basically, that's the standardized security framework you absolutely need if you're going to handle U.S. government data. Now, to be fair, Oracle did step out and deny the accuracy of this reporting. But interestingly, their spokesperson declined to point out exactly what was inaccurate. Microsoft, on the other hand, put out an official statement smoothing things over, affirming that Oracle definitely remains both a partner and a customer, and that they're keeping an ongoing collaborative relationship. But let's look at the ripple effect here. This cancellation represents a potential headwind for semiconductor equipment suppliers. Why? Because the top 4 tech giants, plus Oracle, constitute a massive source of capital expenditure for data centers. When big deals like this stall, it can absolutely impact that supply chain. Looking at how this translates to technical levels, Oracle stock recently hit a wall of resistance right at 194. For the stock to really break out and overcome these current resistance levels, we absolutely need to see a push above that critical 203 mark. As for Microsoft, the stock slipped below its 392 support level and has essentially entered a consolidation phase. Right now, that whole range between 392 and 435 is acting as resistance. To get back on an upward trajectory, we're looking for a solid breakout above 435. Conversely, if it doesn't hold, there's a probability we could see it test levels down below 375. Section 3, SpaceX acquisition and options. Shifting gears over to the private market and options activity, we have some huge news. SpaceX just filed an 8K document with the SEC announcing an agreement to acquire an AI coding startup for roughly $60 billion. And under the terms, the startup's shareholders will receive SpaceX Class A common stock. Now, sure, that dilutes SpaceX's equity value a bit, but the trade-off is that it bolsters their AI capabilities. It specifically addresses competitive gaps they've had in large models over at their XAI division. Just keep in mind, completing a deal of this size is still totally subject to regulatory and antitrust approvals. Now, the introduction of SpaceX options trading exhibited extremely high volatility. On day 1 of trading, the underlying asset surged 16% intraday up to 225, before eventually closing at 201. That's up 4.83% with a massive 15% amplitude. As we close in on that initial June 18th expiration, this asset is staring down potential dual-directional option squeezes. On the downside, those squeeze target levels are sitting at 200, 190, and 180. On the flip side, the upside targets are distributed at 210, 225, 300, and all the way up to 380, with call options generally outnumbering puts right now. With after-hours trading hovering right around 205, the immediate technical contest we're watching is locked in right between that 200 threshold and the 210 resistance level. Which brings us to Section 4, Retail versus Institutional Liquidity. So what does all this speculative frenzy mean for the broader market? Well, that intense focus on SpaceX options has absorbed a substantial amount of retail liquidity. The data is pretty striking here. If you exclude retail purchases of SpaceX over the past 2 trading days, retail net buying of individual stocks on a 3-day rolling average has literally plummeted to its lowest level since the pandemic. And while retail is heavily distracted, institutional investors and CTAs are largely absent. In fact, CTA buying is currently minimal compared to the downside selling pressure we're seeing. It's a fascinating dynamic. You've got retail liquidity practically drained into a single highly volatile asset, combined with institutional inaction. The result? Subdued price action across the rest of the broader market. Let's wrap things up with Section 5, BOJ and Semiconductor Technicals. On the macroeconomic front, the Bank of Japan just implemented a widely anticipated interest rate hike. Now, you might remember a historical instance where a completely unexpected BOJ rate hike triggered a rapid carry trade unwinding and caused a pretty severe short-term market disruption. But this time around, it's a completely different story. This current policy action was fully digested and communicated to the market beforehand. Consequently, this rate hike is not expected to cause any severe liquidity shocks or detrimental impacts on U.S. equities. Finally, looking at the semiconductor index, a critical support zone has been firmly established right between 554 and 570. If we look back a bit, following a previous false breakdown, the index went on a significant rally. It hit new highs, but it did so on contracting volume. That indicates a price-volume divergence. The current price is sitting right near 591. As long as it remains above that 554 level, the uptrend is maintained. However, a breakdown below 554 would signal significant structural deterioration. So, with institutional liquidity sidelined and capital rotating out of tech, the ultimate question remains: will the market sustain this new breadth, or are we on the edge of a deeper structural shift? Thank you for checking out this explainer.